Welcome to Min Chao, where law, finance, and real estate complexities are made clear, actionable, and empowering. The information provided on this channel is for entertainment and educational purposes only, and does not constitute legal, financial, or real estate advice. For advice tailored to your specific situation, please consult with a qualified professional. If you'd like to consult with us, please book an appointment through our website. Investing involves risk, and you could lose some or all of your investment. Past performance is not indicative of future results. So whether you're looking to protect your assets, grow your wealth, or make intelligent real estate moves, you've come to the right place. Did you know that one of the oldest real estate transactions on record was paid for in beer? That's right. Back in ancient Mesopotamia, around 3000 BC, a plot of land was traded for 30 jugs of beer. Apparently, even our ancestors knew the value of a good brew. Today, we're diving into a question that every real estate investor asks at some point. Boom or bust? How to profit from real estate cycles like a pro. We're going to break down how to spot a real estate boom or bust, what to do during each phase, and how to come out on top. Number 1. Understanding real estate cycles. Think of the market like the seasons: spring, summer, fall, and winter. Real estate cycles are similar, with periods of growth, peak, decline, and recovery. During a boom, property values rise, demand skyrockets, and everyone's eager to buy. But after every summer comes fall, prices stabilize, and the market cools down. Then winter hits, a bust, where prices drop, and buyers disappear. Finally, spring arrives with recovery as the market slowly starts to heat up again. Knowing where we are in the cycle is the key to making smart investment decisions. Number 2. Understanding interest rates. Interest rates are the cost of borrowing money. Think of them as the price tag on your mortgage. When rates are low, borrowing is cheap, and buying a home feels like a breeze. But when rates rise, borrowing gets pricier, and that can put a damper on the real estate party. Understanding how interest rates work is crucial because they influence everything from home prices to your monthly mortgage payment. When rates go up, so do those monthly mortgage payments. That dream home might suddenly feel a little out of reach. As borrowing costs increase, fewer people can afford to buy, which can lead to a slowdown in the market. When interest rates fall, monthly mortgage payments decrease, making home ownership more affordable. This means more buyers can enter the market, driving up demand for properties. Number 3. Factors that affect interest rates. There are several key factors that influence interest rates. First up is inflation. Did you know that in Argentina, during one of their bouts of hyperinflation, if you saw something you liked in a store, you should buy it before the cashier could change the price? Prices were rising so fast that by the time you got to the checkout, your groceries might cost more than when you put them in the cart. When inflation is high, the cost of goods and services rises. Central banks, like the Federal Reserve in the US, often increase interest rates to keep it in check. Imagine the economy is like a massive circulatory system, and money is the blood. The central bank is the heart, pumping money through banks, businesses, and consumers. It's in charge of making sure there's enough money in the system, prices stay reasonable, and the economy doesn't go off the rails. Next, we have economic growth. When the economy is booming, demand for credit increases, which can push interest rates higher. Then there's monetary policy. Monetary policy is all about controlling the money supply and interest rates to keep the economy stable. Central banks set interest rates as part of their monetary policy to control inflation and stabilize the economy. The central banks lower interest rates when the economy needs a boost, like a DJ dropping the beat to get everyone dancing again. They raise interest rates when the economy's on fire, trying to prevent inflation from crashing the party. The central bank can also control the economy through the money supply. They can increase the supply to stimulate growth or reduce it to curb inflation. When the money supply is reduced, borrowing becomes harder and interest rates increase. This can significantly impact the real estate market by reducing buyers and demand, leading to a cooling market. On the other hand, if the money supply expands too quickly, it can lead to inflation, causing property prices to increase. Number 4. Identifying a boom. A real estate boom occurs when property values skyrocket. Demand is high, and everyone wants to get involved. But how do you know if a boom is coming? Look for low interest rates, increasing job opportunities, and population growth in a specific area. You'll also notice that properties are selling faster than hotcakes, with multiple offers driving prices even higher. If new construction projects are popping up like daisies, that's another sign of a booming market. Number 5. What to do during a boom. First, focus on properties in high-demand areas, such as urban centers and popular suburbs. You can also consider short-term strategies like house flipping, where you buy, renovate, and sell quickly to capitalize on rising prices. But remember, don't get caught up in the hype. Buying at the peak can be risky, so always do your due diligence. If you're more of a long-term investor, look for properties that will continue to perform well even after the boom slows down. And finally, keep an eye on the broader economic indicators that affect the real estate market. These include things like employment rates, GDP growth, and inflation. Employment rates tell you how many people are working. Imagine the economy as a giant game of musical chairs. When employment rates are high, most people have found their chairs or jobs, and they're happily seated, making money and spending it. This spending boosts the economy. Gross domestic product, GDP, is essentially the big number that tells us how much all the goods and services produced by a country are worth. GDP growth is like measuring how fast the economy's cake is rising in the oven. If it's growing, the cake is fluffy and delicious. Everyone's buying, selling, working, and making money. This spending boosts the economy. Inflation is the price of things creeping up over time. A little inflation is normal. Prices go up as the economy grows. When the economy is strong, more people have jobs and feel confident about buying homes. But if the economy starts to wobble, it can lead to a slowdown in the real estate market. When things start to cool down, it might be time to cash out. Number 6. Spotting a bust. A bust is when the real estate market takes a downturn. Prices drop, demand wanes, and those who bought at the peak might be in trouble. To spot a bust early, watch out for rising interest rates, an oversupply of properties, and slowing sales. If properties are sitting on the market longer than usual and sellers are slashing prices, it's a sign the market is cooling off. Economic indicators like job losses, a slowdown in economic growth, or changes in government policies can also trigger a bust. Being able to spot these red flags early gives you the chance to adjust your strategy and avoid potential losses. Number 7. What to do during a bust. In a recession, people might not be buying homes, but they still need a place to live. That's where rental properties come in. Invest in properties that generate positive cash flow. Look at the rent you can realistically charge, then subtract your expenses: mortgage, taxes, maintenance, and insurance. If the numbers add up, you have found a cash flow positive property. Focus on areas with strong rental demand and a stable job market to maximize your chances of success. Even during a downturn, a steady stream of rental income can keep you afloat and help you build wealth over time. And remember, recessions don't last forever. Number 8. Timing the market in real estate. Timing can be everything. The goal is to buy low during a bust and sell high during a boom. During a bust, keep an eye out for undervalued properties that have the potential to rebound as the market recovers. Focus on areas with strong fundamentals, good schools, job growth, and infrastructure development. A financial safety net is essential for maintaining stability in real estate investments during economic downturns. Experts recommend maintaining a reserve equivalent to 6 to 12 months of your monthly real estate investment expenses. And always be prepared to hold on to properties longer than expected. If the market doesn't move as quickly as you'd like, timing the market requires knowledge, patience, and sometimes a little bit of luck. There you have it. If you found this video helpful, don't forget to hit the subscribe button to join a network dedicated to informed strategic decision-making. Share this channel with others who might benefit from our content. Click the notification bell to stay updated on the latest insights, strategies, and updates. Thanks for watching, and see you in the next video.